How's it going, everyone? Welcome to episode 10 of the sweep. We're going to go ahead and get started here. Appreciate you guys being here. As always, if you have questions, go ahead and chat those in. You can also leave comments after the fact if you're watching this video on replay. As always, like, share, and follow on social media, facebook.com/daytradesmart, instagram.com/daytradesmart, and the number 1, youtube.com/theprovingground. And if you have any questions after that, you can also email us, info@daytradesmart.com. All right, so today we're going to talk about scalp versus hold, so long-term trades versus short-term trades, because there's a lot of psychology that goes around, that revolves around these things, right? There are common misconceptions about what would be more valuable. Now, we're going to dive into some things. We're going to look at some things, the old ways that these things were done and the new ways. But I want to preface really quickly just by saying that there are some of those ways that we still use, and I'm a proponent of. I have some of those things that are for diversification, right? 401k, things like that. So I'm not dogging them. I'm not saying those are off the table, but rather that that's not the only way, right? So I do want to preface with that, and let's go ahead and move on. So prior to advancements in technology and proper training, we relied solely on traditional ways of investing, most of which was designed to be a nest egg for the future. So it wasn't liquid, right? It's not something that you can earn and spend within minutes. It's something that, just kind of sat there as the markets kind of fluctuated up and down. And if you were in any of those during 2008, 2011, 2016, 2020, you saw some pretty big roller coasters. For those people that retired in any of those years after some of this volatility occurred, it could have set you back up to 5 years or more. So really devastating, especially when you're coming to, that point in your life where you're ready to walk away from your job and just enjoy your retirement. That's one drawback to it. But again, there are a lot of these things that we still use today and that I'm a proponent of as a form of diversification. But I'm also a proponent of being able to do something that allows you freedom to be able to enjoy the fruits of your labor and not just work until you're old enough to, sit around for 5 years and do nothing, and you probably don't feel like doing anything at that point, right? In your youth, right, be able to enjoy the fruits of your labor. As you earn, be able to enjoy the fruits of your labor. More importantly, have time to enjoy it, right? You're not tied to a 9 to 5, or 40, 50, 60 hours a week. So some of those old ways like 401k, IRA, savings accounts, right? Again, not that I'm not a proponent of these things, but those, for the most part, these are the only ways to do it, right? Paying a broker to invest on your behalf, right? And this is still something that people do today. And by the way, when you do like 401ks and things like that, essentially you are, paying someone to put those things away for you. And so in that way, you're paying a broker in that way as well. But if you wanted to purchase a stock or, you wanted to trade, way back there was no real day trading, right? I mean, we have traders that are with our organization now that when they first started, they would get a UPS package with a big binder. They would open up that binder and use rulers to draw on their support and resistance lines and then determine where they wanted to take that trade. And then they would go to a payphone because it would be long distance, and they would call their broker, and they would tell their broker what trade they wanted to be put in. And then they would go to Western Union and wire the money to the broker and then just sit around for weeks and wait to hear back from the broker as to whether or not those trades were successful, right? That's kind of what a day trade looked like. And those guys evolved into now, in the 90s and 2000s when we started getting more online stuff and E10s, electronic communication networks, where that it would pipe us right into the market, and we can place trades in the live market. So that's what we do today, right, with like MetaTrader 4, Robinhood, or any of these other apps that you might use. Those are the ways that we do them now, right? So the advancements in technology have allowed for us to do that, but not have allowed for us to, yes, be able to access other forms of investment a lot more fluidly, but in terms of being successful at executing and winning and actually building something significant, that's where the proper training is involved, right? Which is why a lot of you guys find yourselves here today. So more liquid options seem to be too risky, right? So for good reason, tools and methods which are still used today have poor performance and are unreliable. Okay, and we've talked about this in other sessions. If you guys watch Day Trading for Beginners, we talked about it a lot in there. The What is Day Trading series on our Proving Ground site on YouTube. So the issue is that there's a couple of issues. One of which is that a lot of these methods have existed for a long time. A lot of these indicators that you know, the industry uses have existed for a long time, and when they first were used and introduced, they weren't very successful at that time, right? They were, you know, about what they are now, right? So at least they're consistent at being unreliable and perform poorly, and that's a fact. It's not an opinion. And you might see other indicators, you know, aside from ours, and most of them, and I say most of them because not all of them, but the vast majority of them are all the same indicators that have been being used since, you know, the beginning of day trading, and they just dress them up differently, right? But for the most part, it's all the same stuff, and there are very few people that have actually ventured out and tried to create something different, because it's difficult and it's time consuming. It takes a long time. When our indicators are created, you know, it took, you know, years for them to get to a place where they were consistent and accurate, and it wasn't even for another, I don't know, 8 years, 10 years before it was even available to everyone else outside of, you know, just a small group of people, friends, family type thing. And so when it got started when 2008 occurred, because we watched as tons of people in the market were winning at one point and then started losing in 2008 because the strategy the market changed on them, and their strategy accounted for the market just remaining and doing what it had always done. And so when that trade occurred, or rather when that change occurred, their strategy just began to fail. And I mean, literally, some of them who were making, you know, $500K a year or more were bankrupt within a few months and had to sell everything and go and get a regular job. You know, so you don't want to find yourself in that situation ever. And that's why we plan for those things. There's ways to plan for those things. History does tend to repeat itself in terms of the overall look of the market, not necessarily specific prices. You know, the market doesn't always return. That's one of those big lies that I think a lot of people are told and believe, that, oh, well, you know, I'm just going to let it ride out because it'll return eventually. First of all, even if it does, you know, the cost for doing that is enormous. It cuts out the whole liquidity aspect of your account, and eventually it's going to bite you, right? And the market may not return to that level for a really long time. There are levels in 2015 and 2014 that we still have yet to see the market return to, right? There are other levels that, since they've been hit, have yet to return. Maybe one day they will, right? But we're talking about over 2 decades now that they haven't returned to those levels. So we don't expect those things. We don't try to build a trade plan out of those things. And by the way, if you're in open trades, a lot of times your broker will not allow for you to withdraw from your account if you have an active open trade. So you have to close and resolve all your trades, and then you can you know, withdraw. So again, it cuts out that liquidity aspect of it. All right. So the fact that now with day trading, with new technology, with proper training, we can create something that has longevity. It's something that works very well for us, and it's profitable. then we can get to a point where we're exchanging our hours for dollars, and now we're spending a little bit of time to make as much or more than we've made in our jobs and our careers. Even we have people that have traded that had really good careers and went to college and have master's degrees and MBAs and PhDs, and they're lawyers and so on, and at the end of the day, what they realize is that all that time, effort, energy, all the time they spend on their practice, doesn't leave any time for anything else, not friends or family or anything else, right? They have this fiduciary responsibility that supersedes everything else and doesn't allow for them to enjoy the fruits of their labor until they someday retire, right? So you can make what they make, and they can make more than that, and we can make more than that, right? And not have to spend the rest of our lives grinding away for it, but actually be able to enjoy it, in our youth, or if you're elderly, then have a higher quality of life, or whatever it might be, right? But not have to wait to be able to enjoy your fruits of your labor. And a lot of that is the old ways, right? The 401ks, the IRAs, the savings accounts, things like that you had to kind of sit on and cross your fingers and hope that you're getting, these positive returns. Now, I want to take it onto a micro level. I want to look at it, I want to kind of shrink it down a little bit and look at it just based on different time frames. So we're going to look at the double cross today. Now, for those of you guys that are mastermind members and follow, are part of our program, you guys are more familiar with the classic pattern. So this is not the classic pattern because we're not using pressure as an additional parameter. We're just simply using the double cross, which on shorter time frames tends to work a little better, and more often than your classic, which is the same parameters as the double cross, but added with the addition of having pressure agree with its short-term bias, which line is on top or which line is on bottom. So let's go ahead and look at these. I'm going to bring up our charts, and the first thing we're going to be looking at is going to be a 15-minute chart. These are all Euro USD. These are all linked. All four of these first charts are linked. So let me just make sure I know where everything is here. Okay. Oh, not that one. Okay. Good. I'm missing a chart now. There it is. Okay. Put that one on the end over here so I know where it's at. Okay. So first thing we're going to look at is the 15-minute charts. And on these 15-minute charts, you can see that we have our double cross. This first example is really weak, but it's there. Green is crossed with red on majors, and minors are also crossed. Now, the parameters are just that they resided below the overbought like this, right? And then simultaneously, you notice that neither of them are crossed. Minors are not crossed, majors are not crossed, right? And on the next candle, right here, they're both crossed simultaneously after having been oversold, right? So right here, they were oversold, neither of them crossed. Here, now they're both crossed and pointing up. That's our double cross. Excuse me. Now, we're going to just look at a one-to-one on this one. So we're going to look at a 5-pip take profit and a 5-pip stop loss. Now, I want to be clear, this is just for targeting purposes. If you want to know the stop loss and take profit you would take on this particular setup, you would have to back test it because it's going to be specific to the times that you trade, the currency pairs you trade, so on and so forth. But just for the sake of our exercise today, we're going to use these parameters, a 5-pip stop loss and a 5-pip take profit. Now, I wanted to be as fair as possible, so I used a specific time that we would be taking these trades, and we'll take them just in a linear path, right? So we'll just have a starting point and then go to an end point. So we're going to look at 4 examples here. Now we can see that it is oversold, and our other examples will be if they're overbought above this blue line and then cross down together, and then we take a sell, okay? So what we're looking at essentially is just this agreement by way of major and minor, even just for a brief moment. They're both agreeing that they're going to go up. And the idea is to figure out how much they go up for the times that you trade and the currency pairs that you trade when they have this agreement. They're oversold and simultaneously they double cross and point up. Or they're overbought and simultaneously they double cross and point down. Right? And then we'll take a long trade here. So I'm going to replay this because I want you guys to also focus on when we would actually execute the trade. Okay? So let me replay that. And I'm going to show you guys some numbers afterward. And the reason why we're looking at this on a micro level is because what's important is not necessarily how much movement you get, right? Excuse me. What's important is understanding how your trade works out so you know how much risk to associate to it, and that risk determines what your trade is going to be worth. Okay, so if we're using a 1-to-1, and let's say we're risking 2%, right, then 2% of whatever our account balance is what our risk would be, and because it's a 1-to-1 risk reward, we're also going to earn 2% when we win, right? So if we lose 2%. If we win 2%. So if we hit this, say, 70% of the time, then 30% of the time we're losing 2%, and 70% of the time we're winning 2%. You can see how that would be more profitable, right? And we've talked about this numerous times. So let's go ahead and take a look at this one. We don't have our setup yet. The candle just started. It's 13 minutes and 45 seconds left. I'm going to fast forward a little bit here. I'm just going to go 10 times the speed. Let me erase this line. There it is. We know it's there now because we got that green pylon right there telling us it's there. So we got about 11 minutes. I'm going to fast forward a little more there. 4, 3, 2, 1, 2 minutes. So about 2 minutes. And you can see it's kind of faded off with 2 minutes and 7 seconds left. There it goes. It came back. We got about 48 seconds. 2, 1. So 18 seconds, right? So as soon as that candle turns over, right, this 15-minute candle, as soon as it ends with all of our parameters present, that's where we press the button, the buy or the sell button. And this is important. I think a lot of people struggle, a lot of traders that we talk to struggle with some of these concepts where they don't know when they're supposed to actually enter the trade, right? Is it when the setup is present, anytime the setup is present, or is it when the setup is present and the candle ends? Is it at the beginning of the candle? Should I position and wait for some pullback? You know, a number of things. Where a lot of times when we first start teaching somebody how to day trade with our indicators, we're teaching similar to what we're doing here, which is just very systematic, pattern-based approach, right? Because then it's very clear as to what you should do and when you should do it. So the 3 things we always want to accomplish, right? Identifying the setup, knowing when to place the trade, and how to place the trade. Now the how obviously becomes more difficult because you backtest and you figure out stop loss and take profit, win percentage, risk to reward, risk percentage, you know, all those things. So the how, and in addition to that, how to place the trade in your, you know, in your MetaTrader 4 or whatever trading platform you're using, and how to set a stop loss and take profit, how to set your parameters, all that good stuff, right? So what we're focusing on then today is going to be the identifying it, and knowing when to place the trade. And then we're just assuming the how of 5 pips stop loss and 5 pip take profit. So right there, 18 seconds left, and as soon as that rolls over to the next candle, we would have pressed our buy button, and that would have put us in at 1.21637. Come on, move. Let's fast forward that a little bit. There we go. Okay. All right, so we'd be in that trade, and I'm just going to go a little bit faster than that. And then obviously we want to get to that top blue line, which is our take profit, before we get to this bottom red line, which is our stop loss, because we're buying, right? Now our stop loss, of course, works to protect our account so that if not, well, rather when the market doesn't go the way we want it to, it stops the bleeding, right? Now, mind you, this is like 15:30, now 45 minutes. There we go. So that would have come out profitable right there. And you can see at one point we actually had these cross down, right? And you saw that red pylon. That was indicating that we have a double cross down, but it didn't remain that way. So that's why it's important to wait until the top of the hour. You want for that to be fully formed and then execute your trade. Okay, good. So that one's all set. Let's move on from there. Let's go to our next one. And let me fast forward this just so we can get more candles here. Play. Okay. Here's our next one. And now we have the opposite, right? We're overbought and we've got that double cross, major and minor crossed and pointed down. If we go back one candle, we can see that, yes, in fact, they're overbought, all four lines. And then simultaneously, neither of them are crossed and pointed down. And then simultaneously on this candle, now they're both crossed and pointed down. Okay, so again, to the left of this line, right, the left of that line, this indication that was up, that was up, that was up, that was up. And they're above this blue line. And then on this candle, right, both of them are now crossed and pointed down after having resided above the blue line. And that gives us our double cross. So right here, when this candle ends, we would enter that trade at 1.21679. And then our take profit would be 1.21629, and our stop loss 1.21730. Another great part about day trading, right, that we can trade in either direction. It doesn't matter if the market is going up, we can take our buy trades, or going down, we can take our sell trades, and we make it equal the same amount of profit, right? Okay, so right here, we'd be looking to take our short trade down to that blue line. So there's 15 minutes, 30 minutes, and we would have gotten out of that trade, right? So that one moved down about 5.6 pips, which is more than enough to get out of that trade. Okay, good. So let's look at another example here. So here's another one, and this is, let's see, 1.21598 would have been our entry. And again, you can see down here that we had major and minor pointed down here, and now they're pointed up. So they're double cross pointed up after having resided oversold. And that would give us our go-ahead to take our long or our buy trade. And we would want to get to that blue line before we get to that red line. And that one would have lost, right? That one turned right back around. It only went about 2.4 up, and then it came down 5.8 pips, right? So that would have stopped us out. We would have lost that trade with the parameters that we're using today, of course. Okay. And then let's look at our last one for the 15-minute. Right here. So another short or another sell trade, right? Our entry would be 1.21601, take profit 1.21550, and stop loss 1.21652. So again, going back, both of these lines are above the blue line. Neither of them are crossed. We can see that one's hiccuped, right? Black is up, gray is down, but they're not crossed. And then on the next candle, we see that now minors are crossed, majors are crossed, and pointed, and all four are pointed down. So when that candle ends, we would enter our short or sell trade, right? Right there, first 15 minutes, pretty close, no cigar. And right there. So right there, we'd have gone about 8.1 pips. And drawdown would have been minimal, right? Drawdown was only about half a pip, not even a full pip. And then we went down to 8.1. Good. So really, really simple. It doesn't get any simpler than that. You know, a 5-year-old could do that trade, could identify that trade, right? Really simple. And that's on a 15-minute. So on a 15-minute, we went for 5 and 5, okay? And I'm going to bring this back around here in a moment with regard to scalping versus holding, right? Or bigger trades. So let's go all the way back. Let's go all the way down to a 1-minute chart, okay? And that's what we're looking at here, is a 1-minute chart. And on this 1-minute chart, we're going to be looking for the same setup, right? That double cross, okay? We're not going to be using pressure, just the double cross on the 1 minute. There are some parameters in here for how far we want these levels to be below the oversold or above the overbought before crossing and pointing their respective directions. But we won't get into that today. I just want to show you kind of the foundation of these trades. And as we move down to a smaller time frame, sometimes we do want to get more and more specific, and there's other times where it doesn't matter if we get more, if we have more specificity as to what would qualify as a setup and what wouldn't. And other times it does, just for the sake of being more profitable, right? Having a better win rate with a smaller risk reward, less losers, so on and so forth. Okay. So here, what we're going to be doing, instead of using a 5 and 5, right, we're going to use a 3-pip stop loss and a 2-pip take profit, right? So this is more like a 1.5, 1.5 to 1 ratio. We're risking 1.5 times the amount that we're taking profit, right? So it's a 1.5 to 1 risk to reward ratio, okay? And I'm going to replay this 1 minute. And, I'll tell you one thing about the 1 minute is when you're trading on a 1 minute, I mean, it takes full focus. And there's no goofing off, messing around, because these setups can happen often. And if you walk away for even just a couple minutes, you may very well miss a handful of them, right? A few minutes, right? So you walk away for 5 minutes, you may very well miss, 2, 3, maybe 4 or 5 of them, right? Okay. So right here, we know that, and right off the bat, it looks like this started going in that pattern, right? If we go back, neither major or minor are crossed and pointed up. They are below the red line. And then here simultaneously, all 4 of them are crossed and pointed up. And so right here in 16 seconds, 14, 12, and I'm not even fast forwarding, right? It's just regular time, 9 seconds, it would be time to press the buy button. So I'll simulate this one. 3, 2, 1. New candle comes out right there, and we're into that buy, right? And so our take profit is up here. Our stop loss is down here. And this is 5 pips away. That's 5 pips away from our entry. Now, generally, we're going to get faster, or I'm sorry, not 5. Apologies. This is 3 pips away, and this is 2 pips away, right? So our take profit is closer than our stop loss. Okay, it's a 1.5 to 1 risk to reward ratio. All right, so getting a little bit of drawdown at first. We can see that we're already more than halfway through this next candle because they're 1 minute candles, right? So let's go 10 times the speed here. And right there we would be negative in that trade, right? And here's another setup right here that's about to occur. Whoops. So we're going to come back to this one. And then play. And there's another one. See what I'm saying? I mean, if you're not paying attention even just for a moment, you could miss a whole bunch. So we're still in that original one, right? The one that where we've got these lines set up. Now we're just going to look at 1 hour within this 1 minute chart, and I'll kind of break that down for you guys here in just a little bit. Look at this. Here's another one, and our first trade hasn't even filled yet. So we're going to come back to those. I'll let these finish up first. Oh, come on. Get up there. That totally should have taken profit. Come on. It's probably because I'm fast forwarding. The sim is not picking it up. Let's just wait. Okay, good. So that one would have come out. Let's go. Let's track these other ones because we've got a slew of them, right? I'm going to fast forward that. So let's go back here to this first one. So right there, and it took us, let's count this out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So 17 minutes for that first trade. Okay. So, I mean, it's no picnic. And then the second trade happened while we would have been in that first trade for another buy. Now, just to be clear, if this one went up enough, then this one definitely did, where this one's 1 pip behind, right? So this one would have filled as well. So let's go forward and see where that would have happened for 2 pips. Yeah, right there, 2.7. Okay, good. So that one would have won as well. And then we had this one, right? And this one was for a sell. So if we go back here, we can see that, this one's rough actually. Look at this. I wonder why that one triggered. Because we can see, look at how low these are. They're not above the blue line, right? Gray and red are kind of, red's on the threshold, gray is below. It's because we're looking at the values of the gray and green. That's right. Okay. Nonetheless, these are not. This actually would not have qualified, right? We're not above that blue line. But let's just say that it was. Let's just say that it was. Then we have that double cross, and that would have been for a sell. I'm pretty sure this one loses, just based on how these other two won. And that's 2.1 pips right there. So another 0.9 pips. There's 3.1. So that one would have lost. This one would have lost. Now, again, it doesn't really fit the bill. That's not what it's supposed to look like. We want those to be overbought right here and then double crossed down. But nonetheless, we'll just count it as a loser. And then we see we're overbought here. And now both lines, so again, overbought, green, red, gray, black. Neither of them are crossed and pointed down. Now they're simultaneously crossed and pointed down, so that gives us our entry after that minute. And there we would try to sell. And right there, 2.1, 2.6. That's going to do it. So 3.2. So this one would have lost as well, right? And that's okay. That happens. There's nothing wrong with the trade or anything like that. It's just they don't always win, and that's okay, right? Okay. So obviously, the other thing that becomes evident is that if we're using a larger time frame, and of course this depends on the currency pair, but if it's the same currency pair, let's say, and around relatively the same times or whatever it may be, then you're going to notice that the larger time frame you move up to, the more movement you're capable of getting. Along with that, you're also likely to get more drawdown and be in a trade for longer, right? Where all these 15-minute trades, we were in these, all of them, for at least 10, 15 minutes. That one would have been 15 and done. The other ones we saw were up to 25, 30 minutes, or somewhere in that range. Where this 2-minute, the longest one we've seen thus far is like 17 minutes, right? And that was the longest one. And then in that process, we would have had 2 or 3 of them finish up. So you can see that it could just be a few minutes versus half an hour or an hour or more. Now again, you're getting more pips, you're getting more movement, but it's taking longer, and you're getting more drawdown, right? But more movement, and we know there's more movement doesn't equal more profit. Just because you get more movement in the market doesn't necessarily mean that you're making more profit than if you only took these 2-pip trades, right, with a 3-pip stop loss, or these 5-pip trades, okay? Because it's all going to equal based on your risk percentage. And we're going to get to that point here in a moment. Okay, so let's check this one. The sells have not been good thus far, right? We had two sells that lost already. Go back here, and they were in a row, right? Loser, loser. So we started off with winner, and then, or let's see, yeah, winner. This one won later, right? So let me mark that. Winner, winner, loser, loser, and then now we're at this one. So the 2 that lost thus far are sells, right? This one moved down 1 pip. It's moved up 1.9. 2.6, that's close, too close for comfort. That's 2.7. 2.8, oh. Yep, it happens. Let's see if this one fills. There's another trade set up right there. We're still in this trade. 1.3 and 2.4. Okay, finally, this is how long? 20 minutes. That was our longest trade thus far. And 2 other trades within that time. So let me dash that. Or, no, that one's solid. We're good. So this one won, right? It got close to stopping out and losing, but it still won. And now we're on to our next trade. And right here, this puts us at about 44 minutes into the hour, right? So if you were sitting in front of your computer, you would have been sitting in front of your computer to this point, getting into this trade, and having spent 44 minutes trading. So this is your job, right? You're sitting here, and this is your 44th minute. So right here, again, oversold, no crosses. Majors are not crossed, minors are not crossed. Right here, now they're crossed simultaneously. And we're looking for a long or a buy trade. Initially, it looks like we take heat. 6 micro pips. It only goes up about 7 micro pips. 2.1. We got another trade right there. We'll come back to that one. Look at that. Again, another close call. 2.1 against. And then 2.2, that would have filled somewhere in that range, right? Right there for sure, 3.3. Okay, good. So let's go back to that one. This one would have been a winner. And right here, another one. If this one filled, we know that this one filled, right? Because this one's higher and didn't go 3 pips. This one's lower, and this one did go 2 pips. So we know that this one is going to fill. Well, let's go to market anyways and take a look at it. So right there, 1.3, it only drew down 1.5 to that point. And more than enough. There's 2.8 right there, 3.9. Okay, so let's look. Okay, got that marked, good. And right here, again, overbought. Minors are kind of sideways. Gray's on top, black. Green is up, red is up. So neither of these are pointed down and crossed, and they are above the blue line. Right there, they're simultaneously crossed. Green below red, gray below black. And right there, at the end of that candle, we would enter another sell trade, right? And that one initially moves about 6 micropips and 8 micropips. Then 1.8, 2.9. So right there would have been enough to get out of that trade. Good. So that's another winner. All right, and we're coming towards the end of this trading hour. We're at 58, 59. I think that may have been our last one. Yeah, let's look at this one. So right here, we've got major, minor, oversold. Now notice they're crossed, right? But they're crossed and pointed down. Okay, we want them to be oversold, not crossed in and pointed up in any of the previous candle, and be oversold. And they're both of those things. So they are crossed, but they're not crossed and pointed up. They're crossed and pointed down. And then right there, now they're both crossed and pointed up. From the oversold position, we'd enter a buy trade right there. That one moves down 1 pip, moves up 1 pip. That's 3 pips, so right there, another winner. And that, that would have wrapped it up, right? That's just, we said just an hour. So that's, about an hour. And we can see that we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. Did we not mark that one? 2.1, 2.1. It would have won. Oh, no, that's outside of. So this would have been a winner, but that's the hour before. So we were looking from this point right here forward. If we just took 1 hour, right, of trading. And so it would have started at that candle forward, and that covers 1 hour, right? It's about 60 candles on a 1-minute chart. Out of those, we got 1 winner, 2 winners, 3 winners, 4, 5, 6, 7, 8. Let's go back here. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so we got 10 in here. Oh, right, 8 winners and 2 losers. And that equals 10. 10 trades total with 2 losers. Okay, we won't count that one over there, that winner right there. And we're actually counting a loser that actually wouldn't have been our setup. Maybe it was this one. In any event, one of those just didn't fit the bill. Yeah, it was this one right here. Right? Okay. But let's count it anyway. All right, so I'm going to show you guys kind of the breakdown and bring it around for you. Okay. So you check your traditional 401ks, you check your IRAs, you check your savings, all this different stuff. Even at their most aggressive, you would be clacking your heels for 18, 20% in a year, right? That would be awesome. That would be phenomenal, 18, 20% in a year. There are traders that, would kill for, when they're day trading, kill for 18 to 20%, in a couple months, right? That'd be awesome, right? 5-10% growth in a month is great for a professional day trader as a whole, right? In the whole industry, that's a good number, right? 5-10% growth in just a month, that's awesome. Again, when you compare it to anything else in terms of investment or earning, that's impressive, right? That blows the socks off of most things, okay? So let's look at the scenario that we had today, which was 10 trades, 2 losers, and we took 1 hour out of the day, right, to place these trades, which means we had uninterrupted trade time, right? We weren't being interrupted by kids or spouses or work or anything else. We've dedicated this time just for trading for 1 hour, unadulterated, uninterrupted, and we ended up with 10 trades. Okay, 2 of them were losers, and the other 8 were winners. So this is how they fell out exactly, right? Winner, 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 loser, loser, winner, 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 winner. Okay. If we go back, we can see that. So win, 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 lose, lose, win, 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 win. Okay, so same sequence. And that's important because sometimes when you're looking at them chronologically and adding up, okay, how would each of those have worked out? We can't just use a straight number. We have to compound, right? Because if we lose this trade, that means that the next trade that we trade is going to be for a lesser lot size, not a greater lot size, because then we took that trade on because we lost that trade. So 2% or 3% in this case of a smaller number, right, is going to be less than 3% of that number. Okay, so and then same thing with increasing. 3%, if I won, 1.5% right there, and then I had a new trade come out, then my next trade is going to be worth more than my previous, and so on and so forth and so on, right? Okay, so let's make an assumption here of $2,000 starting account balance, $10,000 starting account balance, and $100,000 starting account balance, okay? So 2,000 is kind of the minimum recommended for the futures or Forex market. A lot of that is so you can get the E10 Pro account, you can get better spreads, better commissions, so on and so forth. Okay? So if we had a $2,000 account and we took a winner, right? So let me show you how these numbers are broken down. 3% of 2,000 is $60. Okay? So if I'm going to place a trade that would equal $60, which is 3% of 2,000, my starting balance, then it would be a 2.0 pip lot size. Okay? And 2.0 is worth $20 per pip. Okay? So if I win that trade, then I win 2 pips. If I lose 3 pips. If I lose 3 pips, $20 3 times is $60. If I win 2 pips, $20 2 times is $40. So I won that trade for 2 pips, and that equals $40. So $2,040, right? That's my new account balance. So going into the next trade, I have a higher lot size because now my balance is higher. And I win that trade. And 1.5% of that is another $40.80. And then I trade my next trade, and that lot size is larger. Now there's a couple pennies, give or take here, just because you can only trade with a lot size. The smallest lot size you can trade on in most cases 0.01. Okay, so sometimes you can't go far back enough to account for the pennies, in your profit. So we're kind of rounding both up and down to try to make it even, but I just want to be clear about that. Okay, and then we hit our loser. 2,058.74 is our new balance. We hit our next loser, so it brings us down to $1,996.98. And then we have 1, 2, 3, 4, 5 winners, right? And you can see the progression, right? So it went back $1,996, which was below capital because we started at 2,000, and then we dug out. So we're at 2,036.92, 2,077.66, 21.19.21, 21.60, 21.61.60, and 22.04.83. Okay. All together, by this last trade, we have increased our account by 10%, right? Because if $20 is 1% of 2,000, then 10% would be 10 times, right? Which would be $200. And we can see that, 2,243. So we increased by more than 10% in that scenario. By the way, that's going to be true for all these scenarios. And this brings me to the point that we were discussing earlier. This is a $10,000 account, right? Now, if we're using the same trade, the same parameters, risk to reward, looking for the same thing, but had a larger account, then we would get a little over 10% growth on that account as well, right? And that would be about 1,024.14, right? That would be our increase for that hour, right? So we'd make $1,000 on that day for that hour. Now we fund our traders a max funding of $100,000. Okay, and so that's what we're representing right here is a $100,000 account, which is it's a good amount of cheddar in your brokerage account, and it allows for you to really maximize your profitability on a daily basis, so that you get to a point where you've got an excess that you can use to live off of and walk away from your job if that's what you want to do, and just enjoy life, right? Okay, so same sequence, you can see the same build and same result, 10% growth, right? So one, the account balance means very little, right? Two, the amount of movement that's occurring accounts for very little by itself, right? You can see a 15-minute, yeah, we took more than double what we took on a 1 minute, right? But we had more drawdown, it took longer, where we could get all 10 of those trades fit into just that 1 hour, right? So there's advantages for both. Okay. So we walk away with 10% growth on that account. So you can see in 1 day, in 1 hour, we were able to do what traders would salivate over to be able to do in a month or in 2 months. Where you can accomplish that in a day, right? In an hour. Okay, and there is a lot of discipline that goes into trading some of these smaller time frames, right? Matter of fact, I don't recommend trading those smaller time frames until after you've established at least a couple of setups that are longer term, like 60-minute setups. And the reason for that is because of all the back testing time that it takes. I want you to get to the level of success as quickly as possible where you're starting to see the fruits of your labor right away, and then that alleviates some of that psychological stress so that you can spend more time back testing something that could take a really long time. Imagine how many setups we had. We had 10 setups in that 1 hour, okay? If we're backtesting a 1 hour setup, we can't have more than one setup per hour, right? Because it's a 1 hour chart. It's not going to set up multiple times in 1 hour, right? It's going to be that one setup that stays that way till the end of the candle. Whatever the setup is that occurred at that time. But you can't have more than one in an hour, right? You can have more than one in a day. So you can see if we're looking at, say, a range of time, let's say, 7 p.m. to 9 p.m., right? Then you could potentially have a trade at 7, a trade at 8, and a trade at 9 with a 60-minute setup, right? Where with a 1-minute setup, you could potentially have, 10 times that amount or more, right? In the example that we saw today, that's 10 trades in 1 hour. So for those 3-hour blocks, that could be 30 trades, right? So imagine collecting data on, 10 trades versus collecting data on 30 trades, right? It's going to take longer. There's just more to collect. So that's why it's always recommended you start with at least, a 60-minute chart or a setup that doesn't happen as frequent, because it could take a really ridiculous amount of time to backtest it. All right. So when we look at this, as it compares to, say, that more macro macro level that we were considering before, whether it's using a broker or using a traditional way of investing, buying and holding stock, right? Maybe buy some stock and you're just hoping that it shoots off to the sky, which is great, and people have done it, but it's not really a long-term strategy, right? It's kind of those one-offs that you get, and sometimes even those you got to sit in for quite some time, maybe even more than a year. Some maybe just a few months, but for the most part you're going to be in that for a little bit. Where day trading on a smaller scale could be worth that and some, right? Whatever you may very well have gotten from that stock, even if it did take off and blow, to sky high, this still has the potential to do that very thing. Matter of fact, and we talk about this all the time, the math shows that 70%, even as low as a 70% win rate with a 1-to-1 risk-to-reward ratio, 2 trades a day, you can double an account every month and a half. So if you started with a $2,000 account, 2 becomes 4 in a month and a half, 4 becomes 8 after that month and a half, so that's 3 months, and now you're at 8,000. Another month and a half, so that's 4.5 months, and that's 16,000, right? Another month and a half, so that's 6 months, right? And that's 32,000. Another month and a half, 7.5 months, 64,000, right? 9 months, 128,000. 10.5 months, it's $256,000. 12 months, that's $512,000. Okay, that's counting the losers. Month and a half, 70% win rate, 1-to-1 risk-to-reward ratio. Risking 2% per trade. You could get to $500,000 from 2,000 as long as you're getting 2 of those trades a day. That's it, just 2. Do the math, guys. Break it down. I'm telling you, I've done it a million times. It's incredible, right? We've put people on that $1 million challenge, and they've done it, and it's blown their mind. They're 3 or 4 months down the road, and they only had a couple grand in their personal account. Maybe they're trading a corporate account as well, but a couple grand in their personal account, and go 3-4 months down the road, and now it's like over $10,000, right? And on its way to being much larger than that, over $20,000, $30,000, $50,000, $100,000, right? I mean, they'll get to some of our traders will get to 6 months and have 6 figures that they've earned. Other traders, it takes a little bit longer. Maybe it takes them a year and a half even to get to a point where they can walk away from their job. They supplemented their income. They've replaced their income. Now they're ready to build wealth, right? And just one quick tip: when you're getting to that point where you're now building wealth, where you're trading for a living, right? If you want to live off of $100,000 a year, right? then you're not going to spend 100. If you earn $100,000 in your trade account, you're not going to spend $100,000. You're going to want to earn, say, $150,000 or $200,000, and then spend $100,000 of it. Because if you take that money out of your brokerage account and spend it, you don't have any leverage to continue to trade on. So you want to keep a certain level of balance in your brokerage account always, right? A good number is $500,000. So you trade up to $750,000. So when you get to $750,000, you take that money out and you put it back to $500,000, right? And then you earn another $250. So now you're at $750,000 again. So you take that out and bring it back to $500,000, so on and so forth. If it takes you a month to earn that $250,000, then you take it out at the month. If it takes you a week, if it takes you 6 months, whatever it is, a year, you liquidate it back down to $500,000, and then you take the excess. That would be, I would say, that would be like the cap. That would be a good cap, is that $500,000 mark. All right, that's what I've got for you guys today. As always, remember that we are still running our promotion for our Trader Lite trial, and a ton of you guys have already jumped on from that, and so you guys can attest to the fact that we are doing one-on-one coachings with you, where we're actually showing you trade setups and explaining them to you, having you practice them with us, having you place trades on them in demo accounts so that we can track your progress, teaching you other skills and resources that you need to be a successful day trader. We're letting you use our indicators, all kinds of, you're getting trade alerts. You're watching webinars that we're taking trades with you live in the market, right? You've got videos, tons and tons, thousands of hours of videos that you can watch at your leisure to continue to progress as a day trader for free. I want somebody, anybody, to show me anywhere else where you can get this kind of just the coaching, just the 2 coaching sessions, okay, just the 2 coaching sessions for under $2,000, right? $1,000 coaching session is pretty standard, but that's for like low end type stuff, right? You're talking about high end stuff. I can show you. There's a guy that, because I've looked at all these guys, right? They're considered competitors, I guess, but they coach day trading, and this guy will fly out to wherever you are in the world. He'll fly out to you, and he'll spend 6 hours with you teaching you everything he knows, and it'll cost you $50,000 for one day. There's no follow-up. There's no additional funding. There's no, videos or nothing like that. He just comes and he fire hoses at you, and you're expected just to remember all of that and then trade successfully, and it costs you $50,000 for 6 hours. So one session, 6 hours. Good luck. Pat on the back. Have at it. I can't imagine in what universe that would be successful, but people pay for it, right? So I'm telling you, these sessions are invaluable, and those are just, in addition to all the other cool stuff that you get with the Trader Lite trial. So try it out. You've got nothing to risk and everything to gain, even if it's just to spend some time with our coaches to tell them that you don't believe in the system and you just want to prove it, right? Make a video about it. I don't care, whatever. Let us show you. We'll make a believer out of you. I'm certain of it. All right, guys, thank you for your time. Thank you for joining us. We'll see you guys next week for another episode of The Sweep. Have a happy weekend and happy trading as always.